Hello and welcome to BloombergQuint. We're still sifting through the implications, the choices of Budget 2022, and we're heading straight into a monetary policy review where some of those choices will help lay the path ahead. Joining us to talk about both aspects, Sajjid Chinoy, Chief India Economist at JPMorgan. Sajjid, thanks so much for coming back here on BloombergQuint. Sajjid, we spoke to you before the budget and we spoke about modest consolidation, I think about 0.5 percentage point. You got that, but the levels were very different. So let me first start by asking you about, you lay down the choices and the budget has made in an article recently. That first choice is perhaps a choice between growth versus how much fiscal consolidation to pursue. In your book, did they get high marks for that balance?
I think so. I think they got that choice right, because I think to appreciate where we are, we should project where we think this year's deficit will likely come out. I think, Jan, Feb, March, everyone said this seems to be very conservative. The tax revenues for this Jan, Feb, March, even if you remain relatively conservative, but not as much as the budget has, this year's deficit could come out to be close to about 6.6% of GDP. And the same thing happened last year. The number for last year was 9.5. When the final numbers came in, it was 9.2. We think something similar will happen. Now, what does that actually mean? It means, from the center's perspective, the total impulse or stimulus that was injected the previous year, for which one has to net out arrear payments, net out asset sales, was about 3% of GDP, 3.1%. And if we do print at 6.6 this year, it would mean that half of that has been withdrawn, 1.6%. So two implications flow from that. That given that half of that has been withdrawn, it would make sense to go slow. If that 6.6 had been budgeted to be 6% this year, it would have meant that 2/3 of the stimulus, the pandemic year stimulus, would have been withdrawn in 2 years, which, given the state of the economy that we've discussed before, activity, jobs, would have been too aggressive. So given that we'll effectively be at 6.6 and half has been withdrawn, another 0.2% seems the right balance between growth and stability. What's interesting is, a lot of that withdrawal is happening through automatic stabilizers. It's happening through much higher tax. Only about 0.5% happens through expenditure cuts. And this is good because tax multipliers tend to be lower than spending multipliers. So when you want to withdraw stimulus, that's the optimal way. And even from an equitable perspective, a lot of this is corporate taxes and direct income taxes, and those should be the sections of society bearing the burden of this withdrawal. So I think given that, that balance seems to be right.
I'll come to some of the sort of risks of the way they've projected their numbers in a little bit. But the other choice then was made within the spending category as to whether to direct it towards capex or towards revenue expenditure or redistributive expenditure. There, the choice seems to be very clear, although there's bickering on just how much capex push has been given.
Right. I think one has to again look at this more holistically and take a 3-year view. If you add up what is on the budget, what's on the IEBR, and what's grants and aid for capital expenditure, and look at that over the last 3 years, it's about a 0.5% increase. We used to be about a 4.9 or 5. 2 years ago, it was 5.4. This year, it may come down to 5.2. The budget has picked it up back to 5.4. I think a 0.5% increase is perhaps the most we can do, given the state capacity required to execute capital expenditure. Anything more than this, I think, may not be doable. But so I think the way I think about this is the center's capex spending used to be about 1.5% of GDP over the last, 3 years ago. It's now about 2.5% of GDP. So the fact that the new normal on the budget is a percent of GDP higher is, I think, what we should take some comfort from, even though, as you said, there are, some question marks about exactly how much is off balance sheet and on balance sheet this year.
There were some questions thrown at them as to whether they could have budgeted more for Manrega. I know the whole demand-led scheme and they can do it later, whether they should have budgeted for higher subsidies. I think the argument there perhaps is that if you have projected your tax revenues in a very conservative fashion, even if those demands come up later in the year, there is some space to meet that.
I think that's exactly right. Part that perhaps isn't fully appreciated. What the center has effectively done, if you step back from the numbers, is they've got a 0.5% of GDP kept in their back pocket. And you can, so this has been kind of fiscal space that's been created, but not being used. It's created in the sense that the deficit is higher, it's 6.4, it's not 6%, and bond markets are saying borrowing is more. But it's not being used in the sense that people will say revenue expenditure to GDP is 1.3% of GDP lower. So this is a choice that the center has made to say, by potentially under budgeting tax revenues, there's a 0.5% of GDP that we can use or deploy later in the year. Now, if it turns out that oil prices spike, one could theoretically cut excise duties more aggressively. If it turns out that fertilizer prices remain high, one could use that for higher fertilizer subsidies. If it turns out, God forbid, there's another wave, one can resume the free grain program for a few months. So my point is, you have that 0.5% of GDP. More generally, I would say, if growth still needs support, that can be spent. But if it turns out that oil is the $100 and the current account is widening, then in theory, the 0.5% can be used to consolidate beyond 6.4 later in the year. So in a way, this gives policymakers much more flexibility, but this is not costless.
Yes.
This is, to have this option value means your borrowing program has been higher. It means monetary conditions have tightened, and it means at least ex ante revenue expenditures net of subsidies are down 0.6, 0.7% of GDP, which is not trivial.
No, that was exactly what I was coming to now. I mean, you could have chosen to perhaps, budget a little bit better better may not be the right word, but less conservatively in terms of tax revenues. Given a slightly lower borrowing requirement, you would have probably not shocked the bond markets as much as you did. Although, the responses we got from Mr. TV Somnathan and others in the government was that, we don't work to the bond markets requirements, we work to the economy's requirements, which is fair. Having said that, it is their problem at the end of the day. There's a large amount of supply that they have to push through the bond markets.
One is, I think a lot of the surprise in the borrowing market wasn't because the deficit was 6.4 versus 6%. It was the composition of that borrowing. That market borrowing was much higher, small savings were budgeted much lower. So in theory, if you had the deficit of 6.4, but the same small savings as last year, you would have had gross borrowing in the 12 handle, not in the 14 handle, and the reaction will be different. But let me make a broader point about the bond market. I know there's a lot of hand wringing about where rates are. We should not be comparing nominal rates now to nominal rates before the pandemic, because there's been a big change in inflation and inflation expectations. And let me just give you a data point here. 10-year real yields today, if you deflate it by core inflation, at about 1.4%. The nominal yield is 6.9. Core inflation is stabilized around 5.5. For the 4 years before the pandemic, those 10-year real yields used to average 2.4%. So in real terms, I know even though bond markets have got a lot of angst, real yields in the bond market, 10-year yields, are 100 basis points lower today than they were before the pandemic. So I think comparing nominal yields is fallacious, because inflation has increased by 150 basis points, core inflation has, and inflation expectations are higher. And ultimately, it's real yields that matter. The second point I'll say, just on the bond market, since we're here, is it's a very steep curve. But what is the curve telling us? The curve has two elements to it. And I think by calling bond markets irrational, I think we're just trivializing more fundamental issues. Yeah. One is the 10-year yield is telling us what markets expect will be future overnight policy rates.
Yeah.
And then there's a term premium. Let's hold the term premium constant. What yield curves are telling us is they expect, given where inflation in India is, that policy rates and overnight rates will actually increase. And that's why the curve is steep, right? So if you look at the one-year bond, the 2-year bond, all of them are suggesting that they expect policy rates to be increased in the next couple of years. And that accounts for the steepness of the curve. So number one, let's look at real yields. Number two, all of this is not term premium. A lot of this is just expectations that as global rates are going up, the central bank will have to raise overnight rates. And when monetary cycles start, curves tend to become more steep. And as monetary policy starts raising rates, curves tend to flatten. But the third last point I'll make is there's also a term premium component. But this is a discussion we've had several times over before the pandemic. Why is the yield curve so steep? And it again goes back to fundamental issues. When household financial savings fall by 300 basis points over a decade, and public sector borrowing requirements go up, ex ante, interest rates, equilibrium prices will adjust and rates will be higher. So that's the term element part, that there's a lot of borrowing in recent years against a backdrop of lower household financial. So I think there are many issues that are encompassed in what yields are telling us.
I'm now getting into the realm of monetary policy, and I may have, sort of come back to some of the points that you've raised. But the broader issue linking, so what happened in the budget and what, stance the monetary policy authorities will take. So at this point, is it about inflation or inflationary pressures that will emerge from fiscal policy, or is it more about just the quantum of borrowings which will weigh more on, the authorities' mind?
So I think the RBI will have to be like a very skilled trapeze artist, but a couple of things to pass through. One is, I think we have to recognize the fiscal policy is contracting, not expanding. Okay, right? So it's withdrawing stimulus, not adding to it, but it's withdrawing it more slowly. It's 0.2% of GDP this year. If you 6 goes to 6.4. Now, given that fiscal is more accommodative, as it should be with an uneven recovery, monetary policy, which was reinforcing fiscal policy, will now need to become a substitute to more accommodative fiscal policy. If for no other reason, that inflation has been stickily between 5 and 6%. More worryingly, inflation expectations, whether you look at households or businesses, have gone up. And so the current calibration of policy rates being, minus 150 basis points may not be appropriate, given the stance of fiscal policy, given where oil prices are, and given where inflation expectations are. So I think the way one should think about monetary policy is exceptional measures were required during the pandemic. We're exiting that pandemic. Fiscal policy continues to be supportive. So monetary now has to slowly going back to its job of anchoring inflation and inflation expectations. Now, what this means is short rates may have to go up. But if one believes that, well, that will cause long rates to go up as well, monetary policy has many instruments to deal with that. What the RBI will not want to do is increase its balance sheet into QE in a year where all major central banks are doing QT and reducing their balance sheet. But there are many ways to get around this. So if, for example, they raise short rates in the coming months, one way to ensure that long rates don't get unhinged is to do Operation Twist. You buy long end and you sell short end. The other ways to sterilize is to buy long end and to do FX swaps. The third could be if your balance of payments is in a deficit, essentially you're selling dollars and soaking in rupee liquidity. What all of this does is it doesn't change the size of the balance sheet, it just changes its composition from NDA and NFA or long end to short end. So I think there are ways to accomplish both objectives. Raise monetary policy as inflation warrants, but then use your tools tactically to ensure that the long end doesn't get unhinged.
So on the inflation point, Sajjid, I mean, there was some sort of a glide path given by Deputy Governor Patra. Now, in an environment where you have an RBI and a separate MPC, I don't know whether that is the official glide path that the MPC intends to follow or not. But given that, you have been above 4% on the headline, maybe not above 6%, but above 4% certainly for a large number of months, 4 has remained high. Should that inflation lever itself be enough for them to act now? And will they act via just the reverse repo, or is it, are we coming closer to acting via the repo, which actually is the policy rate at the end of the day?
So, you're exactly right. Central banks look at Taylor rules and they say, well, there's an output gap and there's an inflation gap. And because the output gap is so large, let me focus on that. But in the third year of the pandemic, you have to rebalance that the weight has to move away from the output gap towards inflation, especially since fiscal policy is working to address an uneven recovery. So the division of labor has to be, let fiscal address that uneven recovery. Let me focus on the other gap. Now, what is the sequence of events? I think quite apart from where real rates need to be, we spoke last time about this, it's the volatility at the short end. Where the sheer width of the corridor with repo at 4 and reverse repo at 335 is meant, given that banks have the choice of how much to. So this is a classical prisoner's dilemma, where every bank said, I want to lock in a higher yield at an auction. And I'll borrow in the overnight money market because some other bank will save over there. Well, every bank did that. There was nothing in the overnight money market. So it becomes harder to anchor monetary policy, A, when you have a larger gap in your policy corridor, and B, when this is volitional and kept in the hand of banks. Right? Both of these things interact with each other. So my sense is the first order of business will be to narrow that gap. And I think if the RBI does it in a couple of steps in an orderly manner, then you bring that gap from 4 to 375 down so that the operating target of monetary policy, the core rate, doesn't bounce 100 basis points a day. Once you've nailed that down closer to the policy corridor, then it would make sense for the MPC to worry about how much that corridor should move up.
Okay. And on the repo rate side, I mean, what will prompt them to act? Because you're already above that 4% and you've looked through that for a while. Are they so slowly going to start moving their messaging that, okay, we are targeting the midpoint of that range eventually, and hence we will start to act on repo beyond a certain point?
So, and I would think so. I think with inflation risks still rising, the expectation this year was there'll be a lot of goods disinflation, because supply chains will normalize, commodity prices were supposed to come off, but the opposite has happened. Oil is now above 90, and because China insists on a zero COVID policy, the normalization of global supply chains could take longer. So I think that, in conjunction with the fact that as the services economy opens up, you could see some price pressures in the services economy. Small businesses have taken large losses the last 2 years. As demand becomes more inelastic, they'll have more space to actually raise prices in the services sector. All of those would keep inflation sticky. My sense is the MPC will slowly go there. I don't think it's anyone's contention that you should force inflation from 6 to 4 in a year. There should be a glide path given the state of the economy. But I think perhaps the time has come, especially given where fiscal policy is, that the rebalancing of the Taylor rule away from the output gap and towards inflation commences non-disruptively in the coming months.
Do we need clearer communication on all of this, Sajjid? I think one of the reasons why Fed policy has so far perhaps not been as disruptive to markets during the taper time is because there's just been so much communication. We're on the other end of the spectrum. We are guessing in every conversation before every MPC.
Now, to be fair, there's so much uncertainty that it's very hard for anyone to predict with any certainty where inflation will be 6 months from now or 12 months from now. And to be fair, the Fed was caught wanting last year because the communication was a lot, but in the wrong direction. Telling everyone that inflation is going to be well anchored, and then it didn't happen, and now they've moved quite rapidly in the last 3 months. I have, for what it's worth, believed that this concept of a dot plot is a good way for the MPC to communicate objectively. Right? That maybe in emerging markets, it's nice for each MPC member to say, well, a year from now, 2 years from now, 3 years from now, where do we see rates? And that's what I meant about yield curves, because yield curves are implicitly pricing in some terminal range, which is much higher than where we currently are. And that's why yields have gone up. So yes, there's a case to be made that perhaps, as this framework evolves, perhaps a dot plot, in the coming years will anchor expectations and reduce. What we want to do is reduce unnecessary volatility and risk premium.
Yes. And also pricing in the worst case scenario. We were speaking to Jayesh Mehta of Bank of America on just bonds a little while ago. And he's saying, markets will very quickly start pricing in the worst case scenario, which may be perhaps what is happening a little bit right now.
I go back to my earlier point in bonds. I know I'm not trying to defend here, but we have to look at real yields, not nominal yields. And real yields today in the bond market are 1.4%. They used to be 2.5%. I mean, again, it's hazardous to compare across countries, but if you look at all emerging markets today, Indonesia has a much smaller fiscal deficit, has a smaller current account deficit. Real long end yields are 3.5%. And they've always been high. So I think we also have to look at the global context. Where are US real yields going? How are real yields evolving for emerging markets? India is always judged in that broader universe. We're not an island.
Just on the liquidity side as well, Sajjid. So, you were alluding to earlier some sort of, sort of combination of tools that could come together for them to buy long-end bonds. As things stand, it looks like they will have to in some way or the other. But then should we worry about, sort of the conflict between debt management role of the RBI and their monetary policy role, fiscal dominance? All of those are sort of larger existential issues to talk about.
There's no easy way out. The emerging markets don't have the benefit of exorbitant privilege that the US has, where things go wrong and the demand for US bonds is even higher when there's risk off in the world. But I think the balance will have to be, don't increase the balance sheet, change its composition. So if the central bank is doing Operation Twist to ensure that long ends don't get unhinged, but selling short end bonds or buying FX and absorbing liquidity, that would be an appropriate trade-off in the sense that the balance sheet is not increasing, you're not adding more liquid, you're just changing its composition. And my sense is it'll be some combination of those tools and gradually raising rates at the short end. That might be the middle part.
And the wind down towards a more sort of normal liquidity situation, even if you remain surplus and you've given up the framework of being near neutral on liquidity, that's still a sort of a protracted period that spreads out over a couple of years, perhaps at least.
Going to take time, because what are the organic manner in which liquidity drains, right? It's only the currency in circulation, which is, depending on the year, 3.5 trillion. You have some increase in CRR. You have to offset that by the dividend that the RBI gives the government. So, right, so once you net those things out, it could be 3.5 trillion a year, and the rest depends on the BOP. So there are only two ways for them to drain liquidity, right? Either selling bonds or you're selling dollars. So I think we have to brace for the fact that this is going to take time to dwindle, which is why if you can't control the quantity of money, you should focus on the price of money. Right? And
through the PRRs, etc.
Well, as in just ensuring that the cost of that liquidity is appropriately priced. As I said, VRRs have worked very well so far because they've been non-disruptive, but beyond a point, it makes it harder to use that tool for more precise marksmanship. Because ultimately you're leaving those decisions in the hands of banks, where occasionally, as we've seen, there can be a coordination problem.
How should we think about global sort of movement in interest rates, particularly Fed tightening, etc.? We haven't had large inflows of bonds, so perhaps to expect outflows is not warranted. But will we seem like a bit of an outlier? We are one of the few economies who are not sort of normalizing and raising rates.
Again, the question is how linked are we? There are some other emerging markets who are much more closely tied to US Fed. The capital account is more open. They've seen more debt inflows, and therefore they worry about debt outflows. And some of these economies, especially in Latin America, have therefore had to preemptively tighten. They've been tightening in anticipation of the Fed recognizing these pressures. So I think the broader point is what happens to the balance of payments. And here, the current account is going to widen, towards 2.5% of GDP or higher, largely because of oil and gold imports. We do get our sticky share of FDI and NRI deposits. So it's not like we're looking at a massive balance of payments deficit of the kind we saw in 2012 or 13. We also have a ton of FX reserves and a war chest over there. So I don't worry about macroeconomic stability. That if the Fed were to raise rates, India is nothing like where we were in 2013. Inflation was 10% then, it's 5% now. The basic balance was worse then, it's better now. FX reserves were much lower then, they're much better now. So I think it's not so much that there's an event risk here, that if we don't raise rates, it's going to be a taper type event. It's more a chronic issue that if realized inflation stays sticky, we know inflation expectations are adaptive and expectations will keep climbing. And once expectations climb, then the trade-off that policymakers have between slack and prices gets less favorable. And I think that's the more chronic issue we need to guard against.
Okay, just last question then, Sajjid. So, both on the inflation front and on the growth front, your expectations for the year, the output gap will slowly narrow over the course of this year. Inflation at this point, do you see it go up above 6%, the comfort band, or do you think that it'll remain elevated, but within that broadly?
I think we see inflation on 5.5%. The fact is there is a fair amount of slack in the economy, and that creates some controls on pricing power. I think the concern has to be input costs are still rising very sharply. And at this point, firms may not have the pricing power to pass it on. But with every quarter that the economy recovers, that pricing power will increase. And the chance of inflation becoming more sticky, I'm not worried about it surging to 6 or 7%. I don't think that's realistic. But getting stuck at 5.5% is a concern that we have to worry about. But broadly, if that's a function of the output gap closing and employment getting better and jobs improving, I think that will give us some comfort at least later this year.
All right, Sajjid, I'll leave it at that. Thanks so much for taking the time to speak to us again.
Pleasure.
Thanks for watching Bloomberg.